greater than 1450.
Is this a contrary indicator?
If it's similar to the risk meetings that we have at my firm, it probably is. So let's go ahead and show the answers. So we'll say that since the balance of the C range is actually north of where we closed last night, that's actually, we'd say 57% of the audience, so a slight majority are picking numbers kind of at or above where we are, which is a good sign. I think in one of the big meetings yesterday, there was a lot of discussion on favorite picks of asset classes, and U.S. stocks seemed in a couple of meetings yesterday to feature. Let's go to the next question. And panelists, just keep in mind some of the answers to these, because I'm going to come back and ask you guys to comment on these as well. So given low-cost leverage in the marketplace, some believe that we'll eventually create a new asset bubble. So where, in the opinion of the audience, do we think the next asset bubble will be? Will it be in real estate, either residential or commercial? In the energy space, which seems to be particularly popular with private equity firms and corporates right now. Emerging market debt, which we talked earlier about the boom in the volumes there. D, high-yield bonds or loans, or E, the ever-popular something else. And let's show the answers as we have them. The something else. Well, maybe we'll ask the panelists to give their views on that one when we start with the questions and see what maybe the something else could be. Emerging market debt seems to be pretty high on the list as well. That's despite a lot of discussion yesterday about the merits of emerging markets, particularly Brazil. So let's go to the next question, which is the source of the next financial crisis from 2014 to 2020. Would that be a fiscal crisis in the U.S., a fiscal crisis in Europe, a growth scare in China, higher global interest rates, or an oil/food price shock? So no other here. You've got to actually pick one. And as we know, it usually comes from something people don't anticipate, but let's put the anticipatable list up there and see what people think. And let's show the answers as we have them. Fiscal crisis in Europe.
Pretty even.
Competing with growth scare in China and higher global interest rates for the leaders. Interesting, the fiscal crisis in the U.S. is very low on the list, which I think the congressman and I had a conversation about that last week, that maybe that's something that's underweighted in the market right now. Maybe that's something you can comment on when we get to the panelist comments. And then the last audience question that we have is really appropriate given the high number of responses we have predicting a fiscal crisis in Europe. What will be the fate of the European Union? How will the composition change over the next 5 years? No change. I guess we're using the broader number of the 27 rather than the 17 here, but all 27 member countries remain. B is all 27 member countries remain, additional countries join, so that's the grow. C is the evolves, some departures, some additions. D shrinks. One or more countries leave, and E totally disband. So I guess the game here is really going to be how many people believe in that. Well, I won't lead the audience, but let you pick your answers. And let's show them as we have them. 45%, so shrinks. One or more countries leave. I guess to some extent it's a debate as to is that technically the same as E, but it seems we've got more or less 76%, maybe 80% are basically calling for some kind of departures from the group. So that sounds like a reasonably constructive to optimistic audience in terms of the views in the S&P for the rest of the year, but pretty negative on Europe. I guess maybe, Richard, if I could ask you to just comment on the year-end scenario. It seems that the lightest weighting was given to the next source of a financial crisis being the U.S. fiscal situation. So can you give us just your brief on kind of what potentially happens at the end of the year, whether Obama wins or Obama loses? Because obviously there's a lot stacked up at the end of the year legislatively that would have to happen. In
Sure. Without taking a position on the presidential outcome, there have been a number of fiscal decisions postponed after the election for obvious reasons. The fiscal determinations that need to be made include extension of the alternative minimum tax relief, the extension of the Bush tax cuts. There's quite a list. It totals $522 billion. Now, the importance of those challenges is it takes overt congressional action to preclude these adverse events from happening. One might question, given the recent track record, whether reasonable minds can come to the center and understand that if we don't take this action, that's a fairly significant drag on the economy going forward into the next quarter. Keep in mind there will be a number of, I expect, lame duck members coming back after the November election because their term does not expire until December 31. So the mix of lame duck members together with a rather disparate ideological view makes that question very difficult to forecast. Secondly, one may recall with clarity the last debt limit extension discussion. That has been postponed now and must take place before December 31 at its absolute latest. Treasury has some tricks in the bag that they can give us a little time, but before year end, that must happen. The last piece of this U.S. puzzle is that the Super Committee adopted a series of budget reductions measures which are automatic in their effect, the bulk of which are half coming from defense, the other half from health care. There are various forecasts about what this may mean if it goes into effect. Keep in mind, this also requires overt action by the Congress to keep these from automatically taking place. You take that $522 billion of taxes increase, you then add the inability to come together on the debt limit extension, and you put on top of that the automatic sequestration, you have a potential for a pretty significant drag going into the first quarter of whoever the next president might be.
Yeah, and it sometimes feels like, as this audience reflects, that may not be fully discounted into the markets. I don't know, Josh or Bennett, you've got views on kind of the outlook for Europe, which seems to be, in the audience's opinion, really the biggest driver of market activity that we're likely to see in the near term. If
we would say that's the right topic to focus on. Perhaps the better question about Europe isn't, will the fate of the European Union hold together? I think it absolutely will. But more to who will stay in the euro currency.
Sure.
And there are 17 nations that are part of that currency. Everyone took a big sigh of relief when Greece didn't have an unstructured default. But, structurally nothing has changed in Greece, and in 2 or 3 years' time they will be back to Germany and the ECB asking for more money. And that's going to really put some pressure. No country has benefited more from the euro currency than Germany, and they are totally committed to keeping it together. They'll do just about anything in terms of providing liquidity to keep that currency robust. In many respects, Germany still has the guilt associated with World Wars I and II, and they have no interest in investing in the military, but they will conquer Europe without firing a shot based on the strength of their economy. And they're very focused on how to do that. So now the attention is kind of shifting over to Portugal and Spain. Kind of scary to us that 50% of the youth in Spain are unemployed. One of the risks that we think is underestimated in the financial markets is just social unrest, whether it's in Europe or even in the United States, where we probably have about an 18% unemployment and underemployed population. So we are very tuned into what's happening to Europe. We believe they will certainly be in a recession. We think the euro will come under pressure because the ECB is just going to continue to do LTRO 3, if they need to. Their balance sheet has ballooned to some, $3 trillion. It's bigger than the Federal Reserve's balance sheet. They're going to continue to do that in order to buy time, because that's clearly the play that they called in the huddle, and they're not going to vary from it. So they're just going to keep pouring more and more monetary policy into this to provide the liquidity, and what has to kind of give is that euro currency, because they will inflate their way out of the problem.
Senator,
at its heart, all of this is a political challenge, which you have to be a little skeptical about the Europeans' ability to manage in an orderly way. First, you have to save the banks. The ECB has stepped up and injected a lot of liquidity to do that, although a fair amount of that money has been plowed back into the purchase of government bonds in places like Spain, which you have to wonder about in the long term. Secondly, you've got to address the fiscal imbalances with the countries themselves, which involves a lot of austerity, which is becoming politically very difficult to sustain. And in a country where the unemployment rate is 25%, and among young people even higher than that, how much further can you cut and have a consensus within a society about that's where you want to go? And the third thing is, these countries really have to restructure themselves for more rapid rates of growth. That really is the big challenge, but that involves dealing with fundamental parts of the social fabric, like the relationship of labor to capital, how business is arranged, where there are free markets or there are sort of closed shops, all sorts of things that have been in place in these countries for generations. You have to rethink because of the globalized nature of the economy. All that suggests to me a large amount of political instability going forward, governments successively being turned out, and you have to wonder at the end of the day, when the hardest decisions have to be made, the path of political least resistance is always to stick it to the outsiders or to stick it to the bondholders. And so there may be a fair amount of that going on, which all of you need to factor into your decision making. So, will they muddle through? Probably so. But will what I just described happen? Probably so. Because at its nature, it's political.
Josh, how do you think about managing that potential source of risk as you oversee a vast portfolio of investments where your investors are still expecting you to perform despite some of those risks that are out there?
It's a really good question, and you've got a large universe of investors who have actuarial assumptions embedded in their balance sheets where they need to earn a certain rate of return. Yet the structurals, you have fundamental structural problems everywhere that have not been fixed, whether it's in the U.S. or in Europe, and they've been very well summarized by the other panelists here. The solution that appears to be taking shape and has been the solution of choice has been eventually printing currency and making debt obligations worth less while you buy a lot of time along the way. And the good news is people are talking about the problems everywhere, so they probably eventually get solved somehow, but you worry about the fundamental instabilities along the way. And when you're in a zero interest rate environment, you say, well, gee, let's all go buy equities, you get a little worried about that 2% hit to the U.S. GNP that could be coming in the fourth quarter, off a number that's not so fancy in the first place. You get worried about China, you certainly get worried about instabilities in Europe, and you get worried particularly about these social fabric issues, which can cause terrific disruptions along the way. And remind everybody that today's May Day, and there's a lot of people running around in downtown LA and every place else today who are demonstrating the importance of those social fabric issues. So for us, that means that we're better sellers than buyers of long duration debt assets because rates have been maneuvered by governments globally to very, very low levels. We could be wrong. They could be lower next year. And if you think last year, what was the star asset performer on the planet? It was 30-year treasuries because rates came down. Who would have predicted that at the beginning of the year? Not that many people. And it's a hard bet to make anyway. So for us, being exposed to long duration is not a good thing to do. And being exposed to high complexity, balance sheet changing processes that are idiosyncratic is probably the safest way to escape the macro issues. You can choose to buy equities, but I think you're subject to some serious potential for disruption along the way. And given the extent of the recovery in your graph in equities in the last 6 months, I think it's natural to expect a breather right now. So that's how we're positioned, and it means that I think the average price of the debt securities in our portfolio, and the debt securities right now are about 85% of the securities that we own. There are some miscellaneous post-bankrupt equities and other things, but I think the average dollar price is around 50 cents right now, because we're trying not to be exposed to long-duration fixed coupon instruments that have very not fancy yields associated with them.
Sounds like great positioning. Well, I'm going to leave it there. it's interesting if you consider the question that we asked about the source of the next financial crisis. The leading choices were a fiscal crisis in the U.S., which Richard laid out a scenario for that, the fiscal crisis in Europe, and then also some of the growth scares in China. I think if we'd had the same discussion a year ago, those were probably the three topics that featured most prominently on that list. Hopefully, if we do this a year from now, we'll have a different list than those three. I suspect a couple of them might still be on there. I want to say thanks to our panelists for all of the work they put into participating on this today. Really very much appreciated. And thank you to our audience. Have a great rest of the day. Thank you very much.